my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. This market is giving me a headache. First off, I must apologize yet again for the multitude of lines and labels I've had to draw on this daily chart. However, technically there's still a lot going on here, and these labels and lines are all valid in my deciphering or attempting to decipher what is happening here. Declines early this year below long moving average, currently 1881, are as a result of three head and shoulders patterns created between August 2021 to January 2022. I already previously exhaustively highlighted all three of these patterns and even pointed them out with a cursor, so I'll not spend much time on these, other than to say they are complex versions of normal workaday patterns. Only one of them, just the one, managed to achieve the primary target on the downside. Nevertheless, there are some interesting points to discuss. The neckline of October 2021 to January 2022 head and shoulders top, currently at 1719, plus the middle time, after a fashion, currently at 1860, managed to stop the decline back at the end of February. The recovery back upwards was prompted by an immediate countering weekly key reversal up over the turn of February into March. This recovery rose up to the neckline of the older August to November 2021 complex triple top, currently at 2012, breaking it even before failing in mid-April, and we've seen prices drop since then. The mess of congestion support around the middle time, mainly the combination of the February 2021 high at 1894, the medium moving average currently 1889, the long moving average currently 1917, and the short medium moving average currently 1921 eroded the bearishness, such that though prices last week pushed below all of them, the market did not have the impetus to push lower below the congestion from February between approximately 1840 to 18 even, within which sits the 50% absolute Fibonacci line for the 21st century. Thus, last Friday's action was a key reversal up that was halted topside by the same congestion of moving averages of the long and the short medium moving averages. This did a lot to fill in the change gap from the previous weekend, but it's still open as a gap. Instead, today, rather than continuing higher, prices opened much lower, and we are seeing a test down towards the same old support between 1840 and 18 even. All in all, this is one of the hardest markets to decipher in recent times. You see the most recent indicator, the golden cross of the short medium moving average, currently 1921, up over the long moving average, currently 1917. Though a lagging indicator, is still a bullish indicator. The market's persisted in moving lower below all the moving averages, and again testing the support zone, 1860 to 18 even. That's below this market. I'd like to give this market another week before I try and further decipher this market, as it is just too messed up for me to clearly see right now. Ice Europe, white sugar in London. This market made a big move from the break upwards out of the September 2021 to February 2022 lopsided diamond pattern. The move up took its own time, but 4 weeks ago the market reached up to target X in the 572.20 area. That was the target for the mid-February to mid-April bullish halfway hesitation. Since then we've had the changeover gap lower 3 weeks ago, and prices have pulled back to the vicinity of the congestion from early 2017 in a 517.80 area. This area also includes the neckline from the August to December 2021 possible complex head and shoulders top, currently 518.30, as well as the important rising medium moving average, currently 515.70. All this support is not alone, as just below we also have the rising long moving average, currently at 506.20. This is why for the last 3 weeks we have seen prices hold over the 517.80 area, more or less, and under the old gap from March 2017 between 531.70 to 532.70. Question now is, this period of inter-day indecision, what does it signify? Does it signify a bottom with prices moving back up to the May 2017 high resistance at 548.70, Or does it signify a halfway hesitation with prices tripping down below all the moving averages as well as the congestion area 488.10 to 490.10? This is the question, and to be honest, the current action does not indicate which course of action is preferred. And so I'll try to keep an eye open on any moves below the long moving average or over the old gap from March 2017. Sugar white premium spread. This particular market speaks volumes as to the state of the current New York and London markets individually and collectively. Last week was an indecisive doji cross, the second week in a row, and the third week of indecisive patterns. 3 weeks ago, we had an indecisive spinning top pattern. So we've now had one indecisive spinning top and two indecisive doji crosses in a row. All this comes as the market tries to make sense of a false break higher over March and April at what may well be a false break lower these past 3 weeks. You see, we've had an ascending wedge pattern formed between July 2021 to date. It is a reasonably good-looking pattern and one I would not expect problems for it. However, problems are what has been given, as the lower trend line is the mid-August 2021 to April uptrend, currently at 119.5, which was broken 3 weeks ago. And the upper trend line, currently 120.5, bisects the uptrend this very week. And we run out of space in this ascending wedge pattern. There's one final pattern that I had previously drawn your attention to which still needs to be discussed. It is the quiet and subtle bullish bow tie formation formed over Christmas last year, consisting of the short moving average, currently 107 3/4, short medium moving average, currently 112 1/4, and the long moving average, currently 81 even. What had been interesting back at the time of its formation was how all the moving averages went in and out of the bow tie in the right order, a rare feat in some of these markets. Theoretically, the market should move in the direction of the outgoing moving averages, in this case higher, which we've already seen happen. However, the key move again, theoretically, should happen between 15 to 20 trading sessions after the crossover. In this case, it would be between the weeks of the 4th of April and the 9th of May this year, or in other words, this week is the last week of it happening. Now, I had asked many weeks ago to put a note in your respective diaries and calendars for that period, just in case. Well, we had a big move up during the week of the 19th of April, but it was not sustained. And with this being the last week in the window of opportunity, I fear, with so many recent patterns, at somewhat of a loss as to the potential direction, or directions. Now, there's one final pattern I would like to discuss. I'd previously spoken about this way, and I quote, "Finally, there is a pattern which, whilst not directly touched, may be indicative of the bullish angle of attack. It is the 2019 to 2021 bullish Andrews pitchfork. The market is currently in between the middle time overhead, currently 133 3/4, and the lower time below, currently 59.5. I added further, and I quote, "The upper trend line of the ascending triangle runs approximately parallel to the middle time, and that is also something to watch." End of quote. This bullish Andrews pitchfork is still operational and provides with its middle time the next major obstacle should this market wish to try higher. I'll cautiously wait and see how this market develops out of its state of intraday indecision. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.